Most people come into the market looking for excitement. They want action. They want to trade every swing, every tick, every flicker of movement on the tape. But the real money, the lasting money, isn't made in the excitement. It's made in the waiting. Today we're going to talk about how to catch the big trends. Now, if you remember in the previous video on 5 signs a trend is about to end, we talked about how to spot when a move is losing steam. Well, this one's about the opposite side of that coin. How to ride the powerful moves when they begin and hold on long enough to make it count. You see, the market doesn't reward the restless. It rewards the patient observer who learns to recognize the rhythm of price and time. Every great trend, whether it's in wheat, steel, or stocks, starts small. It begins with a whisper before the crowd hears it, and by the time the crowd finally wakes up, the smart trader has already been on board for miles. Now ask yourself, are you the one waiting for the headlines, or are you the one watching the tape quietly, seeing the signs before the noise arrives? Catching the big trend starts with one thing: positioning yourself before the movement becomes obvious. That's what separates the speculator from the gambler. A gambler hopes the market will do what he wants. A speculator waits for the market to show its hand, and then follows it. The difference may sound small, but it's everything. When you catch a big trend, you're not predicting, you're confirming. You're following the line of least resistance. Now, don't think this is easy. It's simple, yes, but not easy. The public always wants to buy when prices are high and sell when they're low. Human nature never changes. The big trends are born in doubt and die in confidence. Think about that for a second. When everyone's nervous, that's when the groundwork for the next big move is being laid. But when everyone's certain, when the papers, the pundits, and your barber all say it's a sure thing, that's when the trend's nearing exhaustion. Haven't you noticed how the public always seems to arrive late to the party? To catch a big trend, you've got to understand that the market speaks in patterns. It repeats itself because human emotion repeats itself. Fear and greed, they don't evolve. Prices trace out the same formations today that they did 50 years ago. A breakout on the tape in 1905 looked the same as one in 2025. Only the names and numbers change. So, your job as a trader is to study those formations until they become second nature. You have to know what strength looks like, what weakness feels like. Not by guessing, but by watching. Let me tell you something that most traders never learn: the best trades don't feel comfortable. When you're entering a real trend, you often feel doubt gnawing at you. You hesitate. That's because the crowd hasn't confirmed your decision yet. But that discomfort is often the price of early entry. Once the market begins to move in your favor, you'll feel that shift. The pressure lifts, and you know you've caught something real. But don't get too excited. The danger then is overconfidence. How many times have you seen a trader catch the right move and lose it all by trying to outsmart the market? This is where your discipline and money management come in. You can't catch big trends without protecting your capital first. Remember this: the only reason you're still in the game tomorrow is because you preserved your stake today. You have to cut your losses quickly, but let your profits run long enough to matter. Most people do the opposite. They take small profits to feel smart and let losses grow because they hope. But hope has no place in speculation. Hope is for Sunday mornings, not Monday markets. Now, think about what we talked about in that earlier video on the signs a trend is about to end. The moment you learn to recognize when a move is dying, you also learn the anatomy of how it begins. It's the same story told backward. The weakness at the top is the mirror of strength at the bottom. The exhaustion of sellers becomes the birth of buyers. If you can see that shift, if you can feel that energy turning, that's when you're closest to catching a real trend at its start. The first step to catching the big trend is to stop thinking about making money and start thinking about making the right trade. Money is just the scorecard, the trade is the game. If you trade with discipline, the profits will follow naturally. But if you chase profits, you'll always be one step behind the market. You've got to learn to trust your setups, your signals, your understanding of price movement. And when you act, act decisively. The market doesn't reward hesitation. It rewards clarity and courage at the right time. Let me ask you something. How often have you sold too soon? You saw a profit, it felt good, you took it, and then the market kept running. Every trader knows that feeling. I've done it myself. But the big money is not in the buying or the selling, it's in the waiting. When you've caught the right position, when the tape confirms your direction, your job is to sit still and let the market do the heavy lifting. Most people can't do that. They get nervous when prices retrace, they watch every tick, and they end up cutting a winning position just when it's about to accelerate. You've got to learn to sit tight. That's the hardest lesson in trading, but it's the one that pays the most. The market doesn't move in a straight line. Even the strongest trends pull back, shake you out, and test your nerve. But those pullbacks, they're the market's way of measuring conviction. The weak hands get thrown out, the strong hands stay in. Ask yourself, are you one of the weak or the strong? The second part of catching the big trend is knowing the difference between a real move and a false one. False starts happen all the time. A stock breaks out, volume spikes, everyone jumps in, and then the price collapses back into the range. That's not a trend, that's a trap. The true breakout holds above its level. It shows strength after the first pullback. Watch how the price behaves after that first move. That's your confirmation. And once you've confirmed it, your job isn't to predict where it ends. Your job is to ride it until it gives you a reason to get off. That's where reading the tape and the behavior of prices becomes your compass. You'll start to sense the change in character, the speed, the volume, the response to news. That's when you'll know the wind is shifting and it's time to step aside, but never too soon, never just because you're bored or scared of giving back profits. The market doesn't care about your feelings. It only cares about momentum and conviction. And when you catch one of those rare, powerful moves, the kind that pays for a year's worth of waiting, you'll understand what I mean when I say the big money isn't made by thinking fast, it's made by thinking right. Most people can't stand to wait long enough to see that truth. They're too busy trading instead of making money. Big trends start quietly, before the crowd notices. That's the secret most traders never truly grasp. Everyone wants to see fireworks on the chart, a clean breakout, a move so obvious that it practically announces itself. But by the time it's obvious, it's already too late. The market doesn't hand out invitations to the party. It whispers. It hints. It gives you small signs that only those watching closely can hear. The beginnings of great moves don't look like much at first glance. They look dull, uncertain, sometimes even wrong. But underneath that quiet surface, something is shifting. That's how every major trend I've ever seen begins. When the public isn't paying attention. When prices have been moving sideways for weeks, when volume has dried up, when the newspapers have moved on to other stories. That's when the real accumulation begins. Smart money doesn't buy in the spotlight, it buys in the shadows. The professionals enter quietly, carefully, without stirring attention. They don't chase, they position. By the time the crowd notices the movement, the professionals are already sitting comfortably, waiting for the inevitable rush of latecomers to push prices higher. Think of it like this. When the market's been dead and forgotten, it's preparing for its next move. Every prolonged quiet spell is the market building energy. The crowd interprets silence as boredom. The speculator interprets it as opportunity. The tape slows, the chatter fades, and the market starts coiling like a spring. The question is, are you patient enough to notice when the spring is tightening? The mistake most people make is equating noise with opportunity. They want movement. They want confirmation. They want the market to show them success before they act. But that's not how trends are born. A real trend doesn't announce itself with fanfare. It grows in the dark, unnoticed, and only later bursts into daylight. The trader who waits for confirmation from the headlines is already late. By the time the news catches up, the easy part of the move is gone. The early stages of a big trend often feel uncomfortable. You buy and the price barely moves, or it even dips a little. You start to question yourself. The market seems dull, indifferent. That's the market testing your patience. It's asking, do you really believe in your setup? Can you hold your nerve while everyone else looks the other way? Most can't. They sell too early. They lose faith, and when the move finally begins, they watch it from the sidelines, wondering why they missed it again. This is why tape reading, or modern chart analysis, is so important. You've got to train your eyes to see the subtle shifts before they become obvious. Watch the volume, the range, the reaction to minor news. In the early stages, the signs are small but consistent. Strong closes, higher lows, quiet accumulation. You'll notice that the market stops responding to bad news. It refuses to go down even when it has every excuse to. That's a clue. That's the whisper of change. Ask yourself this. When everyone has given up on a stock or a sector, and the tape starts to firm up quietly, do you pay attention? Or do you wait until the talking heads start praising it again? The crowd always waits for permission to believe. The professional trader doesn't need permission. He only needs confirmation from price and volume. When the market stops acting weak and starts building a base, that's when the patient trader prepares. The reason big trends start quietly is because markets move on supply and demand, not excitement. The best trades are made when supply is drying up and demand is slowly building, unseen by most. You won't see that reflected in the headlines. You'll see it on the tape. The float gets absorbed, sellers disappear, and suddenly, when a little demand enters, prices move sharply. People call it a breakout. But in truth, it's just the visible part of a move that began long before. That's why the biggest winners come to those who act before it's fashionable. When you're buying while others are still skeptical, you're in position when the real movement begins. It takes courage, but it also takes preparation. You can't just buy because it's quiet. You have to know what to look for. Quiet accumulation looks very different from dead money. The difference lies in behavior, how price reacts to pressure. Accumulation shows controlled strength. The stock dips, but each time it recovers faster, stronger. It's like watching someone gradually tighten a knot. When it finally snaps upward, it's not an accident. It's the release of built-up tension. Another thing to understand is that markets love to deceive. The best trends often start after fake breakdowns. The crowd gets scared, sells out, and that final wave of panic provides the fuel for the next big move. Smart money steps in when the last of the weak hands are gone. That's when volume quietly starts to build again. No one's paying attention anymore, but the professionals are loading up. A few weeks later, the same stock that everyone avoided is climbing day after day, and suddenly it's hot. But for those who bought early, it's not luck, it's foresight. You've got to develop an instinct for that quiet strength. It doesn't shout, it whispers. You learn it by watching thousands of charts, by living through cycles, by noticing the rhythm of markets. You start recognizing that certain kinds of calm come before a storm. When you've seen enough of them, you begin to trust that feeling. And when it shows up again, you act, not impulsively, but confidently. Catching a big trend before the crowd means being willing to look foolish for a while. It means being early, holding steady when the market still looks asleep. You might endure a few small pullbacks, a few quiet weeks where nothing seems to happen, but that's the price you pay for positioning yourself ahead of time. When the move finally begins, you're not chasing, you're already riding. Most people can't do that. They crave certainty. They want proof. But proof in the market only comes after the profits have already gone to someone else. The quiet stages are when opportunity is still cheap, when risk is small and reward is large. By the time the noise arrives, that relationship reverses, risk grows, reward shrinks. A true breakout holds after the first pullback. That single sentence can save a trader years of frustration and a fortune in losses. Most people think a breakout is just a price moving above resistance, or a stock making a new high. They see it and rush in, convinced that this time it's the start of something big. But most breakouts fail, not because the idea was wrong, but because the trader didn't wait for the market to prove itself. A real breakout doesn't just burst through a level. It stays there when the first test comes. That's the difference between noise and strength, between excitement and conviction. Every great move on a chart begins with that battle, the struggle between the old sellers and the new buyers. A breakout happens when buyers overpower the last line of resistance, but that victory is always tested. Prices surge above the level, volume expands, optimism returns. Then comes the pullback. It always does. The market wants to find out who's serious. Will those new buyers hold their ground, or will they panic at the first sign of weakness? The answer to that question decides whether the breakout becomes a trend or just another trap. You'll notice it if you study enough charts. False breakouts and true ones look nearly identical at first. Both start with energy, volume, and a move through a key level. The difference comes after. The false breakout collapses back into the range. It can't hold the line it just conquered. The true breakout might pause, it might even dip a little, but it refuses to go back under that breakout point. It shows resilience. It absorbs selling pressure without losing character. That's the signal of real demand. This is why patience is a trader's greatest weapon. You don't have to catch the exact breakout candle. You don't even have to buy the moment it crosses resistance. What you must do is watch what happens next. Let the pullback tell you the truth. When price revisits the breakout zone and holds, when sellers can't push it back down, that's your confirmation. That's when the market is quietly saying, yes, this level has changed from resistance to support. Ask yourself, how many times have you bought a breakout only to see it reverse the next day? You felt good for a few hours, maybe a day, and then it all slipped away. You weren't wrong to see potential, you were just early. You didn't wait for the test. The market always tests conviction. It shakes out the impatient, the greedy, and the fearful. Only those willing to wait for proof get to ride the real move. There's a simple rule I've always lived by. If a stock can't hold above its breakout point, it doesn't deserve my money. The market doesn't need to prove me right. It needs to prove itself right. The tape tells you everything. Watch how the volume behaves during the pullback. In a true breakout, the retracement comes on lighter volume. Selling dries up. The market seems to drift rather than drop. Then, as it begins to turn back up, the volume returns. Clean, steady, confident. That's how strength reveals itself. A false breakout does the opposite. Volume surges on the way up, then explodes again on the way down. The market gives back its gains quickly, trapping everyone who chased the move. You can almost feel the disappointment in the tape. It's the market saying. That's why the professionals wait. They know that a true move will give them time to act. They're not afraid of missing the first few points. They care about catching the whole wave. The first pullback is a moment of truth. It's like the market's heartbeat. You can sense its strength or weakness there. If it holds firm, it's alive and healthy. If it collapses, the pulse fades and the setup dies. This is why I always tell traders to pay more attention to the behavior after the breakout than the breakout itself. Anyone can buy a line on a chart. Only a few can read what happens next. This principle also applies to mindset. A true breakout requires conviction, not excitement. The market tests your nerves just as it tests price. You'll often see a position move slightly against you after entry, and you'll want to bail. But if you've studied the structure, if the breakout zone holds, that's your cue to sit tight. A little patience here can make the difference between scratching a small gain and catching a real trend. Think of how this ties to the psychology of crowds. When a stock breaks out, the crowd rushes in. Then, when it pulls back, fear sets in. They think they've been fooled again, and they sell. But the professionals are buying during that pullback. They're taking the shares the crowd just gave away. That's why the best breakouts often have that one brief, sharp dip. It clears the deck. It removes the weak hands. Once that happens, the stock is free to move without resistance. A true breakout holds not because of luck, but because of accumulation. The foundation is solid. Buyers who entered early aren't there for a quick flip. They believe in the move. That belief shows up in price behavior. It's consistent, controlled, not wild or erratic. And as the market begins to rise again, you can sense that confidence spreading. Each dip is shallower than the last. Each push higher comes easier. That's the signature of strength. Let me ask you something. When you see a stock break out and then come back to retest its level, what do? Do you panic, thinking it's over, or do you wait to see how it handles that test? That single decision defines your trading maturity. Beginners chase, professionals confirm. The difference isn't in knowledge, it's in patience and control. Once you start seeing this pattern, breakout, test, hold, you'll realize how often it repeats across markets, time frames, and decades. It's not new, it's just human nature showing up on the chart. Fear sells early, greed buys late, and discipline buys right in between. A true breakout isn't just a line on a chart, it's a story about conviction. It's the moment the market says, "This is the new direction," and proves it by standing firm when tested. The trader who learns to recognize that quiet strength, who learns to wait through that first pullback without flinching, is the one who gets to ride the move while everyone else is still wondering what happened. The strongest trends are born in fear and die in confidence. It sounds simple, but that one truth explains more about market behavior than any technical indicator ever could. The market is nothing more than a mirror of human emotion. Greed, fear, hope, and regret, all playing out on a chart. When you learn to see that emotion not as noise but as signal, you begin to understand where the big money is made and lost. Fear builds foundations, confidence builds tops. Every great move I've ever seen started when people were afraid to buy and ended when they were too certain to sell. When fear dominates, the market looks ugly. Prices are falling, headlines are screaming, and everyone's talking about risk. That's when the public runs away, when portfolios are liquidated in panic, and when good assets are sold alongside bad ones just to raise cash. But hidden in that panic is something valuable, the transfer of ownership from weak hands to strong ones. The smart traders, the professionals, they don't buy recklessly in fear, but they watch. They study how prices behave when the crowd has lost all hope. They look for that subtle shift when the market stops reacting to bad news, when the tape refuses to go lower, even though it has every reason to. That's when fear has done its job. It's washed the market clean. Have you ever noticed how the best opportunities never feel safe? That's not a coincidence. When a market is gripped by fear, prices are discounted, and risk premiums are high. The reward lies in the discomfort. The masses can't act then because fear clouds judgment. But the speculator, the disciplined observer, knows that when emotions hit extremes, they distort perception. The trader who keeps calm in chaos sees what others can't, that fear creates value. The early phase of a strong trend is always uncomfortable. You'll find yourself buying when everyone else is still skeptical. Your friends will tell you you're crazy. The news will be filled with warnings. That's how you know you're early. The market rewards courage backed by understanding, not blind bravery. You must have reasons grounded in price action, accumulation forming, selling pressure easing, volume drying up on declines. Those are the footprints of strength. They appear quietly in the ashes of fear. When the market starts to recover, most people don't believe it. They say it's just a bounce, a trap, a temporary rise before another crash. And sometimes they're right, but the turning point comes when the market stops listening to fear. It climbs a little higher, then pulls back modestly, and climbs again. That persistence, that refusal to collapse, that's the first sign a real trend is being born. Fear still lingers, but it's losing control. Slowly, confidence begins to replace despair. Now, as the trend strengthens, the crowd begins to notice. Prices move higher, volume increases, and the stories start to shift. The same journalists who were warning of disaster a few months ago begin to write about recovery. Analysts raise targets, optimism returns. The same people who were too afraid to buy at the bottom start feeling comfortable again. They see others making money and decide it's safe to join. That's human nature. The trend is now visible, obvious, and widely accepted. But remember, when something becomes comfortable, it also becomes dangerous. Confidence fuels the middle stage of a bull run. It gives momentum its power. There's nothing wrong with that, it's the natural order. But confidence, if unchecked, turns into complacency. As prices rise, people stop asking questions. They stop thinking about risk. They start to believe the trend will never end. You'll hear phrases like, "This time is different," or "the new normal." When those words appear, you're seeing the beginning of the end. The same confidence that sustained the trend now begins to poison it. Think about what happens near market tops. The public is all in. Every dip is bought, and caution is mocked. Brokers are busy, volumes are huge, and speculation is everywhere. That's not strength anymore. That's euphoria. The professionals start selling quietly into that demand. They're not calling the top. They're just taking advantage of the crowd's confidence. They know that the moment the market stops rewarding reckless buying, that confidence will flip into fear again, and the cycle will start anew. Ask yourself, why does it always happen this way? Why do the biggest rallies begin when everything looks bleak, and the worst crashes come after everyone feels invincible? Because human emotion doesn't change. It's the same now as it was a century ago. The crowd always reacts late. They sell at the bottom because they can't stand the pain, and they buy at the top because they can't resist the pleasure. The smart trader learns to do the opposite, not by guessing, but by observing. You can see this pattern in any time frame. In a single stock, in a sector, in the entire market, it's always the same rhythm. Panic, stabilization, recovery, euphoria, and then the fall. The trader's job is to recognize where in that rhythm the market stands. Not perfectly, but well enough to position accordingly. During fear, you prepare. During confidence, you protect. It's simple, but not easy, because it requires going against your instincts. A trader who understands this truth approaches the market differently. Instead of reacting to emotion, he studies it. When others are afraid, he looks for evidence of exhaustion, capitulation, wide ranges with high volume that fail to make new lows, that quiet shift when buyers start absorbing supply. Those are the seeds of a new trend. When others are confident, he looks for signs of weakness, rallies that fade faster, new highs on lighter volume, increased volatility at the top. Those are the warnings that confidence is becoming a liability. The beauty of this principle is that it applies to mindset as well as price. As a trader, your internal emotions mirror the markets. When you feel fear, you tend to sell too soon. When you feel confident, you tend to overstay. The discipline comes from detaching yourself just enough to see those feelings as signals. Your own emotions can be a leading indicator if you learn to interpret them instead of obeying them. So when fear is thick in the air and the charts look broken, ask yourself, what's really happening beneath the surface? Are sellers losing control? Are the strongest names refusing to fall? Those are questions that matter. And later, when confidence floods the room, when profits feel easy and risk feels like a distant memory, ask yourself another question. What's holding this up now? What happens if that confidence fades? Protect your capital first, catching big moves come second. Every trader wants to talk about profits, but few want to talk about survival. Yet survival is the only reason anyone ever gets to see profits in the first place. You can't catch the big trend if you're wiped out before it starts. The market doesn't care how smart you are or how perfect your analysis looks on paper. It only respects discipline. Protecting your capital is not about fear, it's about endurance. It's about staying in the game long enough to recognize opportunity when it appears. I learned early that the market gives you endless chances to make money, but only a few chances to keep it. Most traders focus on entry signals, indicators, and setups, but the true professional spends most of his mental energy thinking about risk. He knows that capital is like ammunition. You can't win a war if you waste it on every small skirmish. That means you take only the trades that matter, the ones where the odds lean heavily in your favor, and you manage every position as if your future depends on it. Because it does. Ask yourself, what's the point of a perfect entry if you don't have the capital to take advantage of it when it finally comes? The big moves, the life-changing trades, they don't come often. They show up a few times a year, sometimes a few times in a career. If you've spent your money chasing noise, you'll have nothing left when the real opportunity arrives. That's why the best traders often seem lazy to outsiders. They sit on their hands. They wait. They protect their stake until the right conditions align. Protecting capital isn't just about avoiding losses. It's about keeping your emotions stable. Every dollar lost is more than money. It's mental energy, confidence, and clarity slipping away. When you're under pressure, you stop thinking clearly. You start making decisions from fear or frustration instead of logic. And in the market, emotion is the most expensive currency there is. You can lose money and recover it. But once you lose discipline, you're finished until you regain control. That's why professionals cut losses quickly. Not because they enjoy being wrong, but because they know small losses are tuition, while big losses are bankruptcy. The market doesn't forgive carelessness. It punishes arrogance, impatience, and hope. Hope is the most dangerous emotion in trading because it makes you hold on to bad positions longer than you should. You start saying things like, "It'll bounce back," or "I'll just wait a little longer." That's not strategy, that's self-deception. The market doesn't know you exist. It doesn't owe you a recovery. Your only job is to protect what you have so you can fight another day.